Okay, get this. Have you ever heard of a crypto company buying jet engines? No, seriously, it's not the start of a joke. It's the absolutely wild, true story of a company called ETHZilla, a firm that basically traded its digital tokens for cold, hard, tangible steel. We're going to break down this bizarre move and what it might just signal for the future of the entire crypto space.
So picture this. It's early 2026. A company named ETHZilla, a name that just screams crypto, makes this huge announcement. But they weren't buying a hot new token. They weren't investing in some groundbreaking DeFi protocol. Nope. They bought two massive, very loud, and very, very physical jet engines. The reaction from pretty much everyone was, what? And that really brings us to the core question of this whole thing, right? Why on earth would a company named after Ethereum and Godzilla suddenly dive headfirst into the aerospace industry? It seems completely random. But as we're about to find out, this wasn't some strange whim. This was a move born out of pure, unadulterated desperation. Let's dig into the details of this very strange shopping trip. Through a brand new subsidiary they cooked up, ETHZilla Aerospace, the company bought two CFM56 engines. Now, if you're not an aviation geek, just know these things are the absolute workhorses of the skies, powering thousands of planes. And their goal? Well, it was to lease them out to airlines and generate a steady, predictable income. Basically, the polar opposite of the chaotic, volatile crypto world they came from. Okay, so to really understand why they'd make such a wild pivot, we have to hit rewind. This jet engine purchase wasn't some bold move they made from a position of strength. Oh no, it was a Hail Mary, thrown from a moment of deep, deep crisis. Let's look at the numbers that really forced their hand. Just look at that number for a second. 97%. That is absolutely brutal. Can you imagine the value of your entire company just evaporating? From its peak in 2025, ETHZilla's stock didn't just dip, it completely cratered. This wasn't a correction, it was an extinction-level event that wiped out billions in value and shattered investor confidence.
And the pain wasn't just some number on a screen. To keep the lights on, to pay off debts, and to desperately try and buy back their own stock to stop the bleeding, the company had to sell off its crown jewels. They sold over $114 million worth of Ethereum. For a company literally named ETHZilla, selling your ETH is like a bakery selling its ovens. It's a huge red flag that things are going very, very wrong.
And you don't have to take my word for it. This quote from their investor call says it all. The people in charge knew, they absolutely knew, that sticking with their old crypto-only strategy was basically a death sentence. The same volatility that made them rich was now on the verge of destroying them. They had to do something radical.
And that radical move was this, a full-blown pivot. They decided the only path to survival was to anchor their digital business in the real, physical world. This is where the strategy completely flips, from pure crypto speculation to something you can actually touch.
So their big new strategy is built around this idea called real-world asset tokenization, or RWA for short. It sounds really complex, but the basic idea is pretty simple. You take a physical thing that generates cash, like a jet engine being leased to an airline, and you create a digital token on the blockchain that represents ownership of it. So if you hold the token, you get a piece of those lease payments. It's a direct bridge from the chaos of the crypto world to actual real-world cash flow.
And this chart just lays out the stark difference. I mean, it's night and day. The old strategy was pure crypto. All their focus was on their Ethereum holdings, and their revenue was completely at the mercy of the market's wild swings. The new strategy? It's a hybrid. It mixes digital and physical assets aiming for stable, predictable revenue from things like leases and loans. The goal is simple, diversify and lower that insane volatility.
And you've got to understand, the jet engines were just the big, flashy purchase that got everyone's attention. This is a full-scale commitment to this new way of thinking. They are building an entire pipeline to bring all sorts of real-world assets onto the blockchain. We're talking everything from home and auto loans to even more aircraft parts.
Okay, so let's circle back to the engines for a minute. How does owning a big piece of metal that hangs off a Boeing 737 wing actually make you money? Well, it turns out to be a business model that is, in almost every way, the complete opposite of crypto. The business model here is almost refreshingly simple. Step 1, you buy a high-demand engine, like the CFM56. Step 2, you lock in long-term lease deals with major airlines. They need the engines to fly, but they often don't want the hassle of owning them. Step 3, you partner with an expert firm to handle all the complicated maintenance. And Step 4,
You just sit back and collect those nice, predictable lease payments month after month, completely disconnected from the madness of the crypto markets.
So, this brings us to the big debate, doesn't it? Is this a brilliant, forward-thinking pivot that's going to save the company, or is it just a last-ditch, desperate gamble? Well, the truth is, it's probably a little bit of both. Let's weigh the potential upside against the very, very real risks they're still facing. Now, the potential rewards here are pretty clear. Number one, they get a stable revenue stream. That's a huge deal. Number two, they diversify their whole business, so they're not so fragile anymore. And number three, this could actually appeal to a whole new class of investors, people who would never touch a pure crypto stock but might be interested in a company that owns tangible, income-producing assets. But, and this is a big but, the risks are just as significant. First off, you've got massive execution risk. I mean, can a team of crypto experts really manage the super complex world of aerospace assets? To pay for all this, they're also issuing more stock, which could hurt existing shareholders. And you have to ask, is the market ever going to truly believe in this strange, two-headed company?
So let's zoom out for a second, because this isn't really just a story about one company trying to survive. What's happening with ETHZilla could actually be a preview of where the entire digital asset industry is headed.
Ultimately, I think the key takeaway is this. For crypto to really mature and grow up, it just can't exist in its own little digital vacuum. These purely online companies are learning a really hard lesson. They need to build bridges to the real world. They need revenue that isn't tied to hype and speculation. ETHZilla's crazy pivot is just the most dramatic example we've seen of this search for stability.
And that really is the ultimate question we're left with. Is ETHZilla a pioneer, building the bridge that will finally connect the innovation of the blockchain with the stability of the physical economy? Or is this just going to be a cautionary tale, a story about a company whose grand digital vision collapsed, forcing them to trade it all in for some grounded, tangible steel? I guess only time will tell.